let's quickly move on to news coming in on the domestic front. If you took out a home loan of 50 lakhs for 20 years before May last year, your EMI would have been 38,000 a month. Now it stands at almost 45,000 a month after rate hikes of 225 bips in the year 2022. Now, most economists now agree that the RBI will once again hike interest rates by 25 bips at least. Now, the reason is that the volatile food inflation has come down, but core inflation remains somewhat sticky. And should the RBI go ahead with the interest rate hike, your EMI is set to rise again. Now, here's a lowdown on RBI's expected move. Let's take a look.
Well, yes, we're looking at largely a 25 basis point rate hike, and most economists are expecting a possible change in stance as well. We're looking at a change from withdrawal of accommodation to neutral. Now, key expectations is that, of course, the repo will move to 6.5%. And when we're looking at how global central banks are largely tracking global inflation, they are actually trying to catch up, which means that they are increasing their rates. So in order to defend the rupee, the RBI will also, to a certain extent, require to hike its rates up. And that's probably why, despite inflation coming within the tolerance band of the RBI will hike rates. We'll also look at commentary around growth, currency, as well as global recession risks. Keep in mind that will impact growth as well. Global recession will mean exports will fall, and some commentary around that will of course help and has been helping all this time as well. We're looking at CPI inflation. We did speak about that, fell below the 6% mark, came at 5.7% for the month of December. In April of last year, it was at 7.8%. So the RBI seems to be doing a good job of this. Looking at views with regard to inflation, it's within the upper tolerance band now. So that's a key positive. With regard to the last meeting, crude was at $82 a barrel, currently at around $77 a barrel. We're looking at 1 USD to INR at just below 83. That's where it largely was last time as well. Bond yields have gone up by around 0.1%, and CPI inflation has come down sharply from 6.8% to 5.7%. So keep in mind there are quite a few positives that have come through since then, and of course the focus may shift on growth. So that's largely what to expect from the RBI meeting this time around. And well, as the MPC meeting is set to be held today, all eyes are on the RBI, which they will bring on new interest rates. And to know more on that, ET Now spoke with experts, of course. So listen in to Shweta Rajani, who is the head mutual funds, Anand Rathi Wealth, and Garima Kapoor, who is the chief economist of Elara Capital.
But if I was a central bank and if I was an MPC committee and I was looking at and taking cues from what's really come out in the budget, I would be extremely happy with two things. One is that the focus of the mandate of this fiscal consolidation has not been compromised, despite it being a pre-election full-year budget. Second is that the pattern of spending or the quality of spending has incrementally moved more and steadily towards capex, which is even more encouraging. And third is that there has been an element to cut back subsidies. So if I was a central bank looking at the fact that are there any cues or any drivers that could be further inflationary from the budgetary spending point of view, I think I'll be fairly happy. And I think that conservative approach of the finance minister will actually bode very well for RBI and MPC when it comes out for decision making. I think it should have been one of the key drivers of why they probably will take a relief from the budget.
We have seen in the last few months is that banks clearly from 2019 have been following the floating rate pattern, which is repo rate plus kind of a model for setting the home loan rates. And in the last few months, 200 bips out of the 225 bips have already been passed on to the home loan buyers. What we have seen in terms of its effect for a long tenor loan, the EMIs have gone up by 20%. For a slightly shorter tenor of home loan, the EMIs have gone up by 10%. Now, this is the impact for an existing investor or existing home loan buyer. For for people looking to buy a home loan, there was this report which came in from Knight Frank, which showed that after the December rate hike, the affordability index had already been impacted by 3%. Moreover, when we are looking at the unsold inventory in the key cities, that stands at 40 months, and that's been inching up month on month in the last few months. So all this is clearly reflecting that there has been a significant impact on the home loan buyers, whether existing as well as new investors deciding whether they should go in for their home loans or no.